Right now, while most people are chasing stocks and crypto, a silent storm is building in the precious metals market that could reshape wealth in 2026. Silver just broke past $90 per ounce for the first time in history. And according to some of the smartest money managers on the planet, this is just the beginning of something much bigger. The problem is that most people have no idea what's happening. They're focused on the noise while missing one of the most important financial shifts happening right under their noses. Ray Dalio, the billionaire founder of Bridgewater Associates, who manages around $150 billion in assets, recently made headlines with surprising advice. He told investors to consider putting about 15% of their portfolio in gold or precious metals, not the usual 1 or 2%, 15%. That's a massive shift from what most financial advisors recommend. But here's what most people missed in that conversation. While Dalio focused on gold in his public statements, the silver market is showing even more extreme signals. And when you understand what's actually happening behind the scenes, you'll see why some analysts are predicting silver could hit triple digits before the end of February. Let's break down exactly what's happening and why this matters for anyone who cares about protecting their wealth. Number 1. The supply deficit nobody saw coming. For 5 years straight, global silver demand has exceeded supply. This isn't a temporary blip. The cumulative deficit has reached almost 820 million ounces. To put that in perspective, that's more than Mexico's entire annual production. And Mexico is the world's largest silver producer. Silver mine output peaked back in 2016 at around 900 million ounces globally, but by 2025 it had fallen to an estimated 835 million ounces. Meanwhile, demand keeps climbing. The math here is simple but brutal. When you take out more than you put in year after year, eventually the tank runs dry. Here's what makes this different from other commodity shortages. About 71% of silver comes as a byproduct from mining other metals like copper, lead, and zinc. This means silver production doesn't respond to silver prices the way normal commodities do. A mine operator can't just decide to dig more silver because the price went up. They're digging for copper, and silver just happens to come along for the ride. Michael DiRienzo, CEO of the Silver Institute, put it bluntly when he said there's no fast resolution to this situation because it's hard to discover silver and even harder to build a mine and get the necessary permits. We're talking about a 5 to 7 year timeline to bring new supply online. That means even if mining companies started today, the supply wouldn't hit the market until 2031 at the earliest. Number 2. China just changed the game. On January 1st, 2026, something happened that most investors completely missed. China implemented new export restrictions on refined silver that are already sending shockwaves through global markets. Under the new policy, only large state-approved companies can export silver, and only after obtaining special government licenses. Why does this matter? These requirements effectively block hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users and refineries. China isn't doing this randomly. This is a strategic move to control a critical resource. Think about what happened with rare earth metals. China controlled the supply, restricted exports, and prices exploded. The same playbook is being run with silver, except silver is even more critical because it's not just an industrial metal. It's also a monetary metal that central banks and governments are starting to stockpile. In 2025, the US classified silver as a critical mineral. Russia began allocating funds to buy silver, and China announced these export restrictions. When governments start treating something as a strategic resource, you need to pay attention. They see something coming that most regular investors don't. The timing of China's move is what makes this so significant. They're implementing these controls right as the physical market is already stretched to its limit. It's like someone cutting off the water supply during a drought. Number 3. Industrial demand is exploding and there's no substitute. Here's where things get really interesting. Silver isn't like other precious metals. Gold sits in vaults. Silver gets used up and destroyed in manufacturing processes. The technology sector's demand for silver has exploded, particularly from electric vehicles, solar panels, advanced batteries, and electronics. Silver is the best electrical conductor available, and for many applications, there's simply no easy substitute. Every smartphone has silver in it. Every electric vehicle uses significantly more silver than a regular car. Solar panels need silver for their conductivity. As the world pushes toward renewable energy and electric vehicles, silver consumption isn't optional, it's required. In 2022, green energy demand accelerated sharply, combining with post-pandemic rebounds in jewelry and investment purchases. Total demand surged to a record 1.3 billion ounces, creating the largest deficit ever recorded at 272 million ounces. The International Energy Agency projects that solar capacity will quadruple by 2030. Each solar panel needs silver. There's no getting around it. And unlike gold, when silver gets used in industrial applications, it's gone. It gets used up in tiny quantities spread across millions of products, making it nearly impossible to recycle economically. This creates a trap. The more we push for green energy and technology, the more silver gets consumed and permanently removed from available supply. But production isn't keeping pace. In fact, it's declining. Number 4. The paper silver market is breaking down. Most people don't realize that the silver market operates on two levels. There's physical silver, the actual metal bars and coins. Then there's paper silver, which is essentially promises to deliver silver in the future through futures contracts and ETFs. Silver's deepest backwardation since 1980 suggests stress in supply and surging physical demand. Backwardation is when buyers pay more for silver today than for delivery in the future. That's backwards from how commodities normally trade. It signals that people want the actual metal right now, not a promise for later. Think about what that means. If you're willing to pay more to have something today rather than wait, you're essentially saying you don't trust that it will be available later, or you think prices will be even higher by then. Either way, it shows stress in the system. At the beginning of 2026, huge volumes of silver bars were being flown from London to New York because people were literally putting metal on airplanes and shipping it across the ocean. Silver is heavy, and shipping it by air across an ocean normally isn't profitable, but fear over tariffs and supply concerns was driving prices high enough to make it worthwhile. The COMEX, which is the main exchange where silver futures are traded, has been showing unusual activity. When physical delivery becomes the benchmark for price discovery, traditional futures exchanges may lose control of global pricing altogether, similar to what happened in lithium and rare earth markets when physical shortages emerged. This breakdown between paper promises and physical reality is one of the key warning signs that a major price move is coming. When paper markets can't deliver on their promises, prices have to adjust to reality. And reality says there isn't enough physical silver to meet demand. Number 5. Ray Dalio's warning about debt and currency. Let's connect this back to what Ray Dalio has been saying. When speaking at the Greenwich Economic Forum, Dalio said, investors should consider parking an unusually high percentage of their portfolios in gold right now because he's a student of history and has warned about the consequences of reckless government spending for several years. He likens the current situation to the 1970s when a surge in inflation, government spending, and government debt eroded confidence in paper currency. During that era, from 1970 to 1980, silver prices increased by over 2,000%. Not 200%, 2,000%. Dalio recently warned that the world may be in a wealth bubble, with asset valuations rising far faster than real money, an imbalance seen before crises like the Great Depression and the dot-com bust. His point is that much of what people think of as wealth only exists on paper, in stock valuations and real estate prices. But when everyone tries to convert that paper wealth into cash during a crisis, they discover how little real money actually exists. In his 2025 market reflections, Dalio pointed out that the dollar fell 39% against gold over the year. Gold returned 65% in dollar terms, while the S&P 500 returned 18%, meaning the stock market actually fell 28% when measured in gold money terms. This is the crucial insight most people miss. When your currency loses value, it looks like assets are going up, but really, your money is going down. Silver and gold are the measuring sticks that reveal what's actually happening to the purchasing power of paper money. Dalio's advice is clear when he says, look at the value of your portfolio in inflation-adjusted terms, not in nominal terms, and that the safest investment right now is an inflation-indexed bond that will guarantee a real return. But he also recommends having somewhere between 10 and 15% of your portfolio in gold as a diversifier, because during stress events, gold will do well when other assets don't. Now apply that thinking to silver. Silver has all the same properties as gold as a hedge against currency problems, but it also has something gold doesn't have, that massive industrial demand we talked about earlier. So silver gets squeezed from both sides, investment demand and industrial consumption. Number 6, the price predictions are getting wild. Alan Hibbard from Gold Silver stated he's expecting silver to perform better in 2026 than it did in 2025, when it surged 147%, and wouldn't be surprised to see the price of silver increase by over $100 per ounce to reach $175 or higher. Philippe Geisels, Chief Strategy Officer at BNP Paribas Fortis, told CNBC he would not be surprised to see silver well north of $100 in the not-too-distant future, while veteran technical analyst Michael Oliver suggested a scenario of $100 to $200 silver by early 2026. These aren't random people on the internet. These are analysts from major financial institutions looking at the same data we've been discussing: supply deficit, industrial demand, government stockpiling, currency concerns, export restrictions, the paper market breaking down. Technical analysis shows that as long as prices remain above the $30 to $50 accumulation zone, the broader bullish thesis remains intact, with the setup favoring continued upside in 2026 targeting $100 and a break above 100 opening the door toward $250 to $300. Here's what makes these predictions different from typical analyst hype. They're based on math, not hope. In 2025, global silver demand reached an estimated 1.24 billion ounces, while total supply, including mine production and recycling, only amounted to about 1.01 billion ounces, representing a deficit of over 230 million ounces. You can't run deficits forever. Eventually, either demand has to drop or prices have to rise enough to bring more supply to market and reduce consumption. Given that industrial demand is largely inelastic, meaning manufacturers will pay whatever it takes to keep production lines running, the adjustment has to come through price. Number 7, the February timeline and what it means. Why February? Why are analysts specifically pointing to early 2026 as a potential inflection point? After breaking decisively above long-term resistance at $50, which acted as significant resistance since 1980, silver is entering a new paradigm where physical scarcity defines value. The technical setup shows silver has broken out of a 40-year consolidation pattern, but there's more to it than just charts. BMI, a unit of Fitch Solutions, sees the deficit in the global silver market continuing throughout 2026, primarily on higher investment demand. As non-yielding assets, silver and platinum have both benefited from interest rate cuts and have also indirectly benefited from the elevated gold price, which has made both metals cheap relative to gold in investment portfolios. The Federal Reserve's monetary policy decisions typically get announced in early February. After political instability around the Federal Reserve and weakening economic indicators, the market now expects multiple rate cuts through 2026, and lower real rates are historically bullish for precious metals, especially silver. When interest rates fall, bonds and savings accounts become less attractive. Money flows into assets that can't be printed, like precious metals. But here's the key timing factor. The surging industrial demand and renewed Fed balance sheet expansion are the key macro drivers behind this structural repricing, with China's export restrictions starting January 1st creating acute supply shortages that are already being felt in the market. Those export restrictions need a few weeks to fully impact the market as existing inventory gets consumed and buyers realize the new restrictions are real and permanent, not temporary. By February, that reality will have fully set in. Manufacturers who thought they could wait for lower prices will realize they need to secure supply now, at any price. This combination of factors, a 5-year supply deficit, government stockpiling, industrial demand that can't be reduced, China's export restrictions, and a Federal Reserve shifting to easier monetary policy creates a setup that hasn't existed in decades. The silver market is sending clear warning signals that most investors aren't paying attention to. Ray Dalio's advice about holding more precious metals than normal isn't about trying to time a short-term trade. It's about recognizing that when governments run massive deficits, print currency to cover debt, and we simultaneously face supply shortages in critical materials, the value of paper money gets eroded. Mike Maloney from Gold Silver points out that silver is just 11.8 times away from its inflation-adjusted all-time high when measured against M2 currency supply, meaning silver hasn't even begun to catch up to the amount of currency that's been created. That gap has to close eventually, either through currency getting stronger, which seems unlikely given deficit spending, or through silver prices rising significantly. The difference between being prepared and being caught off guard often comes down to paying attention to what's actually happening versus what people assume will happen. Most people assume silver will trade in its normal range forever. Most people assume supply and demand don't really matter in modern markets. Most people assume governments won't let commodity prices get out of control. But markets don't care about assumptions. They care about supply and demand. And right now, that equation is badly broken. Whether silver hits $100 or $150 or $200 by February is almost beside the point. The real question is whether you understand what's happening and whether you're positioned accordingly. This isn't about getting rich quick. It's about protecting purchasing power during a period when currency values are being systematically eroded and supply chains for critical materials are breaking down. Ray Dalio's recommendation of 10 to 15% in precious metals isn't a trading tip. It's an insurance policy based on thousands of years of financial history, showing what happens when governments create too much debt and not enough real wealth to back it up. The silent silver storm isn't coming. It's already here. Most people just haven't noticed yet.